The 2008 crash, how banks nearly collapsed the world economy. In 2008, the global financial system nearly collapsed. Banks failed, millions lost their homes, and trillions of dollars disappeared in just a few months. But here's the shocking truth. The disaster that shook the world didn't begin in the skyscrapers of Wall Street. It started with something far more ordinary: home loans. Loans that were quietly transformed into a massive financial gamble, a gamble that nearly destroyed the global economy. This is the real story of the 2008 crash. Before we break it down, make sure you like this video and subscribe to the channel, because on this channel, we uncover the hidden stories behind the biggest economic events in history. Now let's go back to where the crisis truly began. Part 1. The housing boom. In the early 2000s, the United States was experiencing an enormous housing boom. Home prices kept rising year after year. Buying a house suddenly looked like one of the safest investments anyone could make. Banks aggressively promoted mortgages. Lenders approved loans for millions of people who previously would never have qualified. Even borrowers with low income, unstable jobs, or poor credit history were being approved. These risky loans became known as subprime mortgages. Normally, banks would be cautious about lending to high-risk borrowers, but the financial industry believed something very powerful. They believed housing prices would keep rising forever. If a borrower failed to pay the mortgage, the bank could simply sell the house at a higher price. Because of this belief, lending standards became weaker and weaker. People were buying homes they could barely afford. Some buyers even took adjustable-rate mortgages, where the interest rate would increase later. At first, the payments looked affordable, but over time, they could become much more expensive. Still, the housing market continued rising. More loans were issued, more homes were purchased, and the entire system appeared to be thriving. But behind the scenes, a dangerous financial structure was quietly forming. Part 2. Turning mortgages into global investments. Banks soon discovered a way to make even more money from mortgages. Instead of simply collecting payments from homeowners, banks began bundling thousands of mortgages together. These bundles were turned into investment products called mortgage-backed securities. Investors across the world rushed to buy them. Pension funds, hedge funds, insurance companies, and major financial institutions all invested heavily. Why? Because these securities looked incredibly safe. Homeowners were making monthly payments, housing prices were rising, and credit rating agencies gave many of these investments the highest possible ratings. To investors, they seemed almost as safe as government bonds. But hidden inside many of these bundles were large numbers of risky subprime mortgages. If too many homeowners failed to pay their loans, the entire investment could collapse. Still, very few people questioned the system. Profits were rising, Wall Street was booming, and mortgage securities were spreading throughout the global financial system. Few realized that the system was quietly becoming extremely fragile. Part 3. The housing market begins to crack. By 2006, the housing boom began to slow down. Home prices stopped rising. Soon after, they started falling. For millions of homeowners, this created a serious problem. Many people suddenly owed more on their mortgage than their house was worth. This situation is known as negative equity. Borrowers who had taken adjustable-rate mortgages began facing higher monthly payments. Many could no longer afford them. Mortgage defaults started increasing. Foreclosures spread across the country. As homeowners stopped paying their loans, the mortgage-backed securities built on those loans started losing value. Investors began to panic. Banks started questioning the value of the assets they were holding. But there was a major problem. Many of these investments were incredibly complex. No one could clearly determine how risky they actually were. And because these mortgage securities had been sold across the global financial system, uncertainty began spreading everywhere. Confidence started disappearing, and the financial system was approaching a dangerous tipping point. Part 4. the financial system collapses. In September 2008, the crisis finally exploded. One of the largest investment banks in the world, Lehman Brothers, collapsed after suffering massive losses tied to mortgage investments. It filed for bankruptcy. The shock spread instantly across global markets. Investors panicked. Stock markets plunged. Banks stopped trusting each other. Normally, banks lend money to one another every day to keep the financial system functioning. But now, fear had taken over. No one knew which banks were safe and which might collapse next. As a result, lending between banks nearly froze. Businesses struggled to access credit. Companies stopped expanding. Hiring slowed dramatically. Governments around the world suddenly faced a terrifying possibility. If more major banks failed, the entire financial system could collapse. So governments stepped in with massive rescue programs. Trillions of dollars were injected into the financial system. Banks were stabilized. Interest rates were cut. These emergency measures helped prevent a total financial meltdown, but the economic damage had already spread around the world. Millions of people lost their jobs. Millions more lost their homes. The global economy had entered its worst recession since the Great Depression. Part 5. The real lesson. The 2008 financial crisis was not caused by a single mistake. It was the result of many failures happening at the same time. Banks took enormous risks. Investors trusted complex financial products they did not fully understand. Credit rating agencies underestimated the danger, and regulators failed to control the growing risks inside the financial system. Together, these mistakes created a fragile system built on debt and speculation. When housing prices finally fell, the entire structure began to collapse. The real lesson from 2008 is simple. Modern financial systems are incredibly powerful, but they are also deeply interconnected. When risk spreads across the entire system, a single weakness can trigger a global crisis. And in 2008, that weakness came from something surprisingly simple: home loans. A reminder that even the largest financial systems in the world can be shaken by the smallest cracks.